Welcome, Igor and Timo, and thank you for being with us here today. Igor and Timo are both audit junior supervisors with ETL, assurance, and overhides accountants. So let's talk about transfer pricing to start off with. Now, why transfer pricing is because very recently in the UAE, we had the corporate tax come into play effective 1st of June 2023. And one of the very interesting provisions is on the transfer pricing. Of course, the transfer pricing talks about ensuring the arm's length principle. It talks about the various methods that need to be adopted, the documentation that might be required, like the master file and local file. And of course, from a UAE corporate tax perspective, there are certain thresholds which apply for TP documentation. So not all businesses are mandatorily required to maintain this sort of documentation. Now, what I would like to know from your perspective is, since you are coming from a jurisdiction where transfer pricing has been a very normal process in terms of documentation, in terms of policies and procedures, as an auditor, what exactly would you want to check to ensure that the business is complying from a transfer pricing perspective?
Yeah, so it's of course important that the client has like a position paper on why they choose certain prices for certain transactions, and then we have to check if they are at arm's length. So we need sufficient substantiation for their position, which can be quite aggressive, but if there is a good reason for it, then that's fine. Yeah.
So yeah, mostly there's like a third party who issues a transfer pricing report that's done by experts in tax law in the local jurisdiction, in our case, the Netherlands. If there's such a report from a third party expert, we tend to rely on it mostly because although we have been schooled like in that direction, but on a basic level, so not on an expert level, if there's such a document available, we just tend to rely on that. And for us, the matter is then finished because there's there's a third party who confirms the transfer policy for that company.
Now, also what's interesting for me, Igor, is you guys are more from an audit background. So as an auditor, how is it first of all necessary for you to understand what are the various methods, let's say in transfer pricing, before you can actually understand the report that is issued by this third party? Is it mandatory for an auditor to understand these methods? Or how does it help you to conclude that the business has complied with transfer pricing?
It's not mandatory from like audit guideline perspective, but it is from a risk perspective because due to the fact that transfer pricing is mainly tied to profit shifting between entities, there are risks for the financial statements. So from that perspective, we need to understand the transfer pricing policy, but it could also be like an neglectable risk, and then it would just
pass away.
Yeah.
Okay.
So the different methods we're definitely not experts in. So we rely on the documentation we receive from a third party. Third party information for us is always really powerful, of course. And then sometimes we contact the third party as well if we still have questions left to basically let them explain the position of the client they provided the report for. Yeah.
Okay. So now moving on to the topic of IFRS. So in the UAE corporate tax law, what is stated is that businesses will now have to completely prepare their books of accounts based on IFRS. So there are two options. We have IFRS, which is the full IFRS compliance, and IFRS for SMEs. And SMEs in the corporate tax law is it's clarified that any business taxable person that has a revenue of less than 50 million would be considered as allowed to comply with IFRS for SMEs. Now, firstly, I would like to know if there is any such differences from your jurisdictional perspective in terms of complying with IFRS versus a certain other gap that applies for SMEs maybe, and how from an auditor's perspective do you have the reporting requirements when there is a difference in gaps?
So for the Dutch gap versus the IFRS, the Dutch gap is more rule-based because it's based on the Dutch Civil Code, and the IFRS is more principle-based approach, like generally.
Okay.
And for the similarities, they both use an accrual base. And there's, yeah, maybe you can.
Yeah, there are like slight differences in possibilities, mostly with fixed assets. The valuation of the fixed assets, you have a little more options in Dutch GAAP, I think. But they are pretty similar. Most of the Dutch GAAP is like a literal translation of IFRS. Yeah, we also have different sizes of companies. We have, I think, 3 or 4 brackets: micro, small, middle, and then big companies. And there are different reporting requirements for these 4 different brackets.
Okay. And when it comes from a corporate tax perspective in the Netherlands, is there a difference in the gap? Is there any regulation which says that companies need to follow a certain gap or make certain adjustments only for tax purposes?
In the Netherlands, it's allowed to use the local gap, the Dutch gap.
Okay.
But it's, if you want, you can freely apply the IFRS, so to comply with companies in other countries for the consolidated financial statements.
Okay, so as I understand it, there is an option for companies to adopt the IFRS, right, from a corporate tax perspective?
Yeah.
Great. Okay, and another very interesting provision that we have, which I would like to highlight for all those who are listening to us, is on entertainment expenses and interest deductions. So again, I think this is something which is coming out from, I would say, either the EU or the OECD regulations, where related company transactions are being controlled in a certain manner. So one such topic which we also see in the UAE corporate tax law is around interest on loans, which are taken from related parties. So in the UAE, there is a very specific rule that interest on loans in general will not be allowed as a deduction. However, it would be allowed under 2 circumstances on a very what I'm explaining is on a very generic basis, wherein the law says that as long as there is no corporate tax advantage as the intention in the transaction, and the related party that's providing the loan also has a corporate tax or an equivalent concept which is more than 9%. So as you know, the UAE has corporate taxes of 9%.
Yeah.
So if the related party that's providing the loan is taxed at a higher tax rate, then this deduction is allowed for the UAE businesses. Now, how is it in your jurisdiction from a interest perspective? Because I think that's one expense which can be misused, right?
Yeah, it's actually pretty similar, I think. In principle, they are deductible. We also have this boundary, but at us it's not 9%, but it's 10%, I believe, which is actually a lot lower than our local corporate income tax rate. So that's actually pretty interesting. Yeah, the local tax authorities, they are, yeah, this is a big issue for them, and they really take into consideration the at arm's length principle on this one. And yeah, it just takes up a lot of people in the tax authorities to to really do enough research to form an opinion for them on this. There are so many different ways to determine what a at arm's length interest rate could be. That they are doing a lot of work to basically
Get a grip on it.
Get a grip on it, but it doesn't really seem to be that effective for them.
Okay, so what we just discussed is when there is a interest on loan from a related party. But how does it work when it is, let's say, loans from a third party? So is there anything in the law which restricts or allows a certain carry forward of interest to the next subsequent periods, or how does it work? Let's say if there's a loan from a bank, is there some specific rules which apply other than arm's length, because this is not a related party transaction?
No. When it's from a third party, the at arm's length principle doesn't really play any role. That's only an issue when it concerns related parties.
Okay. So then is it safe to say that all other interests are allowed fully as a deduction?
That's true.
Okay,
Yeah.
great. Now coming to the topic on entertainment expenses. So we have a bit of, let's say, a certain level of confusion, okay, when it comes to entertainment expenses, because the question is, in the UAE corporate tax law, it's very clear that if there are entertainment expenses incurred for non-employees, which could be shareholders, your customers, your suppliers, 50% of the entertainment expenses are allowed as a deduction. But if these expenses, entertainment expenses, are incurred for employees, it will be allowed 100%. However, the condition is it should be an expense incurred for business activity. So how is it in your jurisdiction? What are the laws around entertainment expenses?
So in the Netherlands, the situation is that the tax authority can't decide for the companies or entrepreneurs what are business-related expenses and what are not.
Correct.
In for the entertainment expenses, although there needs to be a certain tie to the business operations, and they call it within reasonable limits. So you got like 3 classes. You got fully deductible, partly deductible, and non-deductible. So fully deductible is everything, and then again, if it's tied to business operations within reasonable limits, it can be anything. So, for example, a company clothes with a logo bigger than a certain threshold that would be allowed, or a subscription to a financial newspaper, for example. Partly deductible would be mixed costs. You have a private subscription for your mobile phone to call, but you make business calls, something like that. And the non-deductible, there's by law in the Dutch Civil Code, there's a list of non-deductible things. And then there's a method to deduct these costs. You have the threshold method. I think the threshold was 55,000 euros for 2024. And you have the 80-20 method. So you can deduct 80% of your costs and 20 you cannot. So in the example, 50,000 euros, you could deduct 10,000 by one method and fully do the 40,000 euros, or you could do the 50,000 minus 55, and that will be the deductible amount of your complete expenses.
Okay, so if you have expenses which are commonly used, let's say for personal and business, what I understand from what you said is there is a certain ratio that's allowed to be claimed in such cases, or is there a method? For example, if I can tell very clearly that these expenses are first allocated towards personal expenses, then it would all completely be non-deductible, or is there a certain ratio? How does that work when it's mixed expenses?
So when it's mixed expenses and it's also partly personal expenses for the employee. So for example, in the Netherlands, a lot of employees have lease cars, company lease cars, which they can also use for private use. So we have a concept called bijtelling, which is a certain percentage of the worth of the car. This gets taxed in the wage tax for the employee. So not in the corporate income tax, but this goes straight towards the employee for personal use.
Very interesting. So, what I understand is that if there is a portion which is personal expense related, that would automatically come under the taxation of personal income.
Yeah,
Right?
true.
And lucky for us, at the moment, we do not have personal taxes in the UAE. So I think there is definitely a reason why the laws are framed as it is right now. Interesting. So now let's move on to BEPS Pillar 2. So in the UAE, we are having something called the global minimum tax rate. And very recently, we were made aware of the tax rate, which is about 15%. So this mainly applies to multinational enterprises that have approximately a global turnover of 3.15 billion dirhams. So the global minimum tax rate of 15% would only apply to such enterprises. Now, what is your understanding of the BEPS Pillar 2 from an overall perspective? Because I'm sure this is a topic which is spoken of in many parts of Europe. So what is your take on BEPS Pillar 2?
So the pillar 2 is about tax evasion, if I can say. Because the Netherlands is a European-based country, the European Union, they took on a directive for the minimum effective tax rate. And I think just recently, the Netherlands, they took on the proposal to implement the effective tax rate of a 15% minimum. I think the threshold is 750 million
Euros.
in revenue.
That's right. That's
Don't,
right.
Yeah, don't pin me on that one. I personally haven't done a client with such a high revenue, so I couldn't say. Maybe you can. Have you had
Yeah,
such
so
experience?
of course the corporate income tax rate in the Netherlands is higher than the minimum global tax rate proposed in this pillar. So it's easy to adopt them basically
Of
for our
course.
country.
Yeah.
But for example, here in Dubai, where the corporate tax rate is now 9%, they would probably feel a lot less inclined to accept this. I don't know what the position of the government is on this, but yeah, I think it's healthy for countries to compete with each other as well for the best tax rates, best living quality, stuff like that. So I don't necessarily see a big problem with a lower tax rate or no tax at all. But yeah, I think every country has to decide that for themselves, I guess.
Yeah. So I think we've had a very good conversation. Thank you so much for being with us today. And before we wind up, would you like to say anything to all those who are listening to us and watching us as to what your feedback is in terms of being in the UAE, because you've experienced, let's say, in this 1 week, how we work and what the culture is around? And I think Timo has already been here before to the UAE, so this is not your first time. So what do you have as a feedback, just for everybody to know?
Yeah, first of all, thank you for having us here. It's been a really great week here. Learned a lot. Yeah, feedback for the UAE. I actually really like it here, especially the business climate here is great, I think.
Everything is catered towards
Yeah,
succession.
like we talked about before, in the European countries, it can feel like for some people that the government is out to get you at times, and I don't really have that feeling here, business-wise. Like they are trying to lift you up, trying to help you, trying to make your life as easy as possible so you can focus on the task at hand. And I think that's the main difference between Europe and the UAE.
Do you have something to add, Igor?
No. We talked in private about this matter a lot, and no, I'm fully on one line with Timo. This was really what we thought about the Emirates, and yeah, it feels what I said, more catered towards seeing businesses succeed, seeing individuals succeed. So yeah.
Great. Thank you so much for
Thank
being
you.
with us today. Thank you.
Yeah,
Thank
thank
you.
you.